Hi everyone, welcome back to the channel, and if you are new here, I'm Jenna. On this channel, I talk about property in Singapore where I share easy to understand breakdowns, practical guides, and also my personal thoughts on different property projects and topics. And today's topic is a big one. Can a HDB owner realistically upgrade to a private property without stretching themselves too thin? Because let's be honest, a lot of people want to upgrade, but they're not sure if the number actually makes sense. So in this video, I'm going to walk you through a realistic case study so you can see how this might work in real life. Meet John and Amber. They are a typical working couple currently staying in their 4-room BTO HDB. They both earn a combined income of $12,000 per month, and with their BTO just reaching MOP, they're exploring whether upgrading to a resale private condo makes sense for them. Let's start with the most important part. How much cash do they actually walk away with after selling their HDB? So let's say they're selling their HDB at 750K. From that, we deduct the outstanding loan, 270K, CPF plus interest used, 225K, legal and agent fee, which is about $19,350. After all the deduction, their cash proceed comes up to about $235,650. And that is actually all real cash that they can pocket in. Next, we'll talk about their CPF. How much CPF do they have for their next home? Aside from the 225K they will have after selling their BTO, they also have extra funds that are sitting in their CPF OA account, which they can also tap into. Now, I want to pause here for a moment because this is where a lot of people get confused. Where this extra CPF amount come from? To make things easier to understand, I've created a simple table. This table assumes that when John and Amber first bought their BTO, their combined income started at about $8,000 a month. Over the years, as their career progressed and income gradually increased, and today they are earning about $12,000 combined. As their income increased, their monthly CPF contributions also increased. So even while paying for their HDB, they are still contributing to their CPF ordinary account every month. So when you look at the numbers over time, after about 5 years, the additional CPF accumulated in their OA comes up to an estimated $54,000. This $54,000 is on top of the 225K they get back from selling their HDB. When you add both together, that gives them a total CPF amount of $279,000. And this is why many homeowners are surprised. When they do a proper breakdown, your CPF doesn't just sit there. As your income grows, your CPF grows with it. So when upgrading, it's not just about how much CPF you have used, but also at how much you have built up over the years. So after combining everything, the cash proceed plus the total CPF fund, that gives them $514,650 available to use for their next home. And notice this, we haven't even touched their personal cash savings. This is purely just from selling their HDB. Now comes the next big question. Is this enough to buy a private property? Let's assume they are buying a 3-bedroom resale condo at $1.6 million. Here's what they need upfront. 25% down payment, which is about $400K. 5% must be cash. 20% can be used with CPF, cash, or both. They also have to pay for the buyer's stamp duty and the legal and other miscellaneous fee. So the total upfront amount needed is $454,600. Remember earlier, they had $514,650 from cash proceed and CPF. So the answer to whether the couple have enough money to buy? Yes, they can fully cover this without touching their savings. But now comes another question and concern. Can they sustain the mortgage? After all, definitely it's gonna be a lot more than what they are paying for their BTO right now, right? So before we talk about whether John and Amber can afford the condo loan, here's one very important rule where we need to understand, and that's TDSR. If you never heard of it before, don't worry, I'll explain it in a very simple way. Now, TDSR stands for Total Debt Servicing Ratio. What it means is, banks are not allowed to lend you an amount where your monthly debt repayments are too thin compared to your income. In Singapore, the maximum TDSR is 55%. So the bank looks at your gross monthly income and make sure that all your monthly debt combined do not exceed 55% of that income. This includes your home loan, car loan, study loan, credit card installment, any other ongoing monthly commitments. Let's say a couple earns $12,000 a month combined. 55% of $12,000 is $6,600. That means the bank will only approve loans where all monthly debt repayment combined stays below $6,600. Now imagine they already have a car loan of $1,000 a month. That leaves only $5,600 for the home loan. And if their ideal home loan requires $6,000 a month, the bank will reduce the loan amount or even rejects it because the total repayment would exceed $6,600. So now that you understand how TDSR works, let's apply this rule to John and Amber's situation and see whether their upgrade actually is feasible. So here you can see that for the 1.6 million 3-bedroom resale condo that they have been eyeing on, the bank will loan them 1.2 million. Their combined income comes to $12,000, assuming they do not have any other loan. So the TDSR at 55% gives them a maximum of $6,600 per month. Their estimated monthly installment comes to about $4,199, which is well within the limit. After using CPF to offset part of the installment, their actual monthly cash top-up is about $1,439. And if you remember the balance amount they have after paying upfront for their down payment, they still have about $60,050 left for their funds, which can cover around 3.4 years of cash installment. Now, this 3.4 years is essentially a safety net for them. Even if something unexpected happens, like maybe one person changes job, takes a career break, there's a period of income uncertainty, they are still able to continue paying their mortgage for at least 3 years. This kind of buffer gives them time to adjust, time to recover, and most importantly, a peace of mind. So, for John and Amber, this upgrade is not just possible, it's comfortable and sustainable based on their current numbers. So the key takeaway from this case study that we have just went through. Yes, a HDB owner can upgrade to a private property, but it only works with careful planning. This example shows what's possible. I'm not saying everyone should upgrade. This is really about understanding whether it's financially feasible if upgrading is something you're considering. Because the truth is, every situation is different. Your income, CPF, loan, lifestyle spending, and risk tolerance, all this will affect whether upgrade is comfortable or stressful for you. So before making any decision, I recommend to sit down with your agent and do a proper breakdown together. Look at the numbers clearly, stress test the scenario, and make sure the upgrade is feasible without overstretching yourself. And at the end of the day, it also comes down to your own comfort level. So we have come to the end of this video. If you're currently thinking about upgrading, but you're not sure whether it makes sense with your current lifestyle and commitments, you're more than welcome to scan the QR code on the screen and reach out to me. I'm happy to offer a free consultation where we can go through the numbers together. If you find this video helpful, don't forget to like and subscribe to my channel if you want to see more practical real number property breakdown like this. I'm Jenna, thanks for watching, and I'll see you in my next video. Bye-bye!